time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold.
Okay, so this question came in from Jack, who is a current client, via email, and he said, curious about Alexandria Real Estate Equities REIT. It has a long-term debt at a low interest rate, long-term occupancy with over 90% of space occupied, and apparently there was a recent large percentage rental rate increase, and both Motley Fool and Zacks recently singled the stock out for it being a bargain. So we'll see if it is potentially a bargain here. So Alexandria Real Estate Equities Inc., ARE, on the New York Stock Exchange, currently trading at a price of around $120 per share, a market cap of $20.7 billion, and a dividend yield of about 4%. Now, it is an office REIT focusing primarily on the life science and biotech markets, and the stock was essentially cut in half over the last year. Now, I wrote year to date in the intro that I sent to Ryan just to prank him, so he would say year to date, not year. Just kidding. I made a mistake. Whoops. The stock was cut in half over the last year, not year to date. Sorry for making you look bad, Ryan. Okay.
You only make yourself look bad, don't worry.
Exactly. At least I'll, admit it. Okay, so looking at the actual company, so Alexandria is an owner, operator, and developer of collaborative life science, ag tech, and advanced technology campuses in AAA innovation cluster locations, including the Greater Boston, the San Francisco Bay Area, New York City, San Diego, Seattle, Maryland, and its Research Triangle. Now, the company has about 850 tenants and an asset base in North America of about 75.6 million square feet as of March 31st, 2023. So Alexandria claims that its differentiation is the cluster model in life science, ag tech, and advanced technology campuses that provides its tenants with highly dynamic and collaborative environments. And as you can see here, I put up on the screen just what their Seattle cluster looks like. So essentially, they have a cluster of buildings which they are renting out to companies that are in this ag tech life science, and essentially the key is to have them kind of work together and benefit off of each other. And just as a last note, Alexandria also provides some strategic capital to transformative life science, agri-food tech, climate innovation, and technology companies through its venture capital platform. And as of March 31st of 2023, the company had about $1.6 billion in investments on its balance sheet. Now, let's actually get into the financials here. So the most recent quarter was Q1 of 2023. Now, total revenue was up about 14% to $700.8 million from about $615.1 million in Q1 of 2022. And the growth was primarily driven by strong rental rate growth of about 48%, which represents the highest quarterly rental rate growth ever in the company's history. Now, same property net operating income growth was about 3.7%. Adjusted funds from operation per unit was up about 7% to $2.19 in the quarter. And as of March 31st of 2023, Alexandria held about $1.26 billion in cash and debt of about $11.6 billion, providing a net debt position of about $10.3 billion and a trailing net debt to AFFO multiple of about 8 times. And as Jack mentioned in his email to me, the company's long-term debt has a weighted average interest rate of about 3.7%, and essentially all of its debt is fixed rate with no maturities until 2025, and a bulk of the maturities taking place after 2027. And quickly looking at the valuation, it trades with a trailing price to AFFO multiple of about 14.5 times. And I did take a look at the recent conference call transcript and just a few forward-looking comments that management made. They said, in response to the uncertainty and volatility in the markets, management made a strategic decision to reduce 2023 construction spend by about $250 million. Now, they're still going to spend $2.7 billion in the year. As well, they are also looking to allocate about $225 million for acquisitions throughout the year. And about 95% of its leases contain contractual annual rent escalations, approximating about 3%. So looking at the actual guidance, or looking forward at the company's 2023 guidance, management anticipates to maintain about 95% occupancy and have rental rate increases of about 28% to 33%. And AFFO per unit is expected to grow approximately 6.4% to $8.96. And this would equate to a forward price to AFFO multiple of about 13.4 times. So to conclude here, I think that Alexandria is a relatively attractive REIT, but I'll let Aaron be the judge afterwards. Especially a company that's operating in the office REIT space. Now, it pays a decent dividend yield and has a reasonable payout ratio. It also has grown that dividend considerably over time, where it paid an annual dividend of about $1.40 in 2010, and that is now to a forward yield of about, or dividend of about $4.84. So they've increased it substantially since 2010. Now, the company has also produced good AFFO per unit growth over the last 9 quarters and is projecting for about 6.5% growth in 2023. And while it trades at about 14.5 times trailing and about 13.4 times forward AFFO, I do not think that the valuation is unreasonable for this growth rate. Now, I also think that the company's balance sheet is relatively attractive, given that a majority of its debt is fixed and it has reasonable leverage ratios. But yeah, I don't think that it's a bad REIT overall, especially for a company operating in the office REIT side of the industry.
Yeah, definitely a specialized name in the life sciences space. You mentioned reasonable leverage ratios. Do you have those offhand?
Yes. So I believe I said, so it is, 1 second here, 8 times net debt to trailing AFFO. And then management is guiding, if I go over here, management is guiding to a net debt to adjusted EBITDA multiple of about 5.1 times. And that's by annualizing their Q1 results here. So,
Right, right.
what do you think? What do you think about that? Like 5.1 times net
Yeah,
debt
I
to
like it.
adjusted EBITDA? Is that,
Yeah,
yeah,
for a
not too
REIT,
bad, hey?
for a REIT.
Mm-hmm.
Yeah, assuming that it has good clients, which I mean it seems it does. No, I mean I like it. It has a nice yield. Payout ratio is good. It's got some growth, some same property growth, some
Mm-hmm.
development growth, valuation. What was that, about 14 times AFFO? Looks okay.
Yep.
Looks
Yep.
decent.
Trailing. Mm-hmm.
Specialized. I mean, it's an opportunity to invest in the life science space. Not. I mean,
Mm-hmm.
I'd need to look further to actually say if it's a
Yep.
recommendation or not. But
Of
I like
course.
it. I see so
Yeah,
far.
it's not bad. I guess my like one thought too is, and I'd have to dig in and maybe like look further, is, Jack is right that they are planning on increasing rental rates significantly. Like, as you can see, rent rate increases for the 2023 year are supposed to be 28 to 33%. How long can they continue to push that kind of growth on the rental rate? I'm not sure. I'd like to dig further into that. Is that just kind of a 1 year thing? I mean, even as they were saying, in the recent quarter, the growth was primarily driven by strong rental rate growth of about 48%, which represents the highest quarterly rental rate growth in the company's history.
Mhm.
How much further can that kind of growth go on? I guess is a
Yeah, for
question that
sure. I
I would
wonder if
have.
they're affected at all by their office rates, people, not returning to the office as much and work from home type trends. I mean, it may be improving for them, people going back, right? And so just is that something to maybe track
Yeah,
there.
that's
I
another.
I
would
did
think with
also,
science there would be less of that because a lot of that is research, right?
you would
Yeah, it's like a
think,
lot of like
yeah,
labs and stuff where you actually have to
yeah,
kind of be, but
you need a
it's a good
clean
point
lab or
still.
something. It's hard to do that at home,
Yeah.
but there could be support staff or something. It may be
Certainly, yeah.
yeah. I'm not sure. Yeah, I'm not
I
sure
know
how that would
generally the
affect them.
office suite space is definitely not my favorite.
Yeah.
But this being a specialized, like more of a niche player,
Yeah.
it's
And I
certainly
did
worth
like how
considering.
Brendan mentioned the word cluster a lot. It was really
What did
fun
you
to
just
hear
call me?
Brendan
Did you
say
just call me
cluster,
Brandon?
cluster. What's your name, Brenda?
The Branda.
Sorry, Brendan. Yeah, I don't even. Let's be honest. I never get
Mine
it.
doesn't know any of our names, so it's
I don't even know anybody's name.